Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and here is a look at the stories for the day. The Reserve Bank of India kept the key policy rates unchanged in its monetary policy review, surprising most experts who were betting on a reverse repo rate hike. Governor Shaktikanta Das said that the Monetary Policy Committee will continue its growth supportive stance till there are signs of a durable recovery. Our next report tells about what the central bank's status quo means.
Going against popular expectations, the Reserve Bank of India's 6-member Monetary Policy Committee voted to keep the repo rate and the reverse repo rate unchanged for a 10th straight meeting at 4% and 3.35% respectively. The rate-setting panel decided by a majority of 5-1 to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy. The RBI has projected real GDP growth at a modest 7.8% for FY23. Economists largely predicted a hike in the reverse repo rate to fight inflationary pressures. Reverse repo rate is the rate RBI pays banks when they park their excess liquidity with it, and therefore a hike would have meant sucking out some liquidity from the system. The gap between the two key rates, called the policy corridor, is maintained at 25 basis points during normal times. Governor Shaktikanta Das, while acknowledging that the overall system liquidity remains in surplus, also gave justification for why the RBI had left the reverse repo rate unchanged. He said the central bank had managed to achieve a rise in the effective reverse repo rate in the market to 3.87%, compared to 3.37% in end August, in a non-disruptive and seamless manner without adjusting the official rate. The effective rate is based on the weighted average rate of the fixed rate reverse repo and the variable rate reverse repos of longer maturity. To the question on why the RBI has not followed in the footsteps of other central banks in unwinding liquidity, Das said, the character of inflation is somewhat different in those economies compared to India. He said the improving inflation outlook provided comfort to the Monetary Policy Committee, which believes that retail inflation edging higher to 5.59% in December was due to unfavorable base effects. Now, economist Madan Sabnavis decodes the RBI policy review.
To begin with, we have seen that there has been a lower forecast made for inflation at 4.5%, which I think is probably the biggest surprise. But what this means when you combine it with a growth rate of GDP of 7.8% is that the government is still not sure about the durability of growth. It feels inflation is fairly benign, which in turn means that there is going to be very little case which can be made for increasing the repo rate. So in fact, while the accommodative stance was not a surprise, but the fact that it said that it's going to maintain an accommodative stance even in 22-23 is indicative of the fact that the repo rate is definitely not going to be changed, and we could be expecting the repo rate to prevail at 4%. So I think this has been a very big benefit for the markets because the markets were expecting rates to be increased. And the immediate impact is that the bond yields have come down. The other important thing is that why couldn't the RBI actually have increased the reverse repo rate? It wouldn't have made much of a difference because the RBI has mentioned that the weighted average reverse repo rate has actually increased from August to February, and right now it's in the region of something like 3.84%. So it's well within the corridor which the RBI was talking of, 3.75 to 4%. Now, the implication of this really is that the RBI knows that there is surplus liquidity of around 7 lakh crores. It knows that there would be situations in next financial year when these funds could be required. And when they are required, they need to be there. So rather than working on trying to suck out this surplus liquidity from the system, this particular measure of the RBI of focusing now on the 3VR rate, that's a 14-day 3VR for managing liquidity, actually is a way in which it could facilitate the government borrowing program, as well as a demand from the private sector, which is likely to come up.
The expectation that RBI won't tinker with repo rate in the near future bodes well for borrowers. As floating home loan rates are directly linked to the repo rate, a continuation of the accommodative stance supports the environment of affordability. Home buyers will get to enjoy decadal low home loan rates for some more time.
After the RBI's status quo on key rates, let us move on to some action in the skies. A swarm of 1,000 India-made drones lit up the night sky with different formation over Vijay Chowk during the beating retreat ceremony last month. Just 11 days later, the government on Wednesday put a halt on the import of drones to give a fillip to India's fledgling drone industry. Will this recent move help lift the fortune of nascent drone industry? Our next report tries to find some answers.
BotLab Dynamics, a startup incubated at IIT Delhi, put up a 10-minute drone show on January 29th during the culmination of Republic Day celebrations. The humming of 1,000 drones and their formations into shapes of globe, Make in India Lion, the National War Memorial and Mahatma Gandhi left the audience in awe. Only the US, Russia and China have the capability to put together such a show with 1,000 drones. Union Minister of State for Science and Technology Dr. Jitendra Singh took pride in the fact that the project was developed indigenously. The drone show gave a glimpse of the things to come as the government aims to make India a global drone hub by 2030. Just 11 days after the show, import of drones was stopped to give fillip to domestic manufacturing. India currently imports most of its drones and components, particularly from China. And China's DJI technology is the world's largest drone maker. Except for research and development and for defense and security purposes, the import of drone for any other purpose will need government permission now. Import of drone components will still be allowed. This move comes after the easing of rules for registration and operation of drones in the country, and also after the announcement of the production-linked incentive scheme worth Rs 120 crore to boost the manufacturing of drones in India. This amount is nearly double the combined turnover of all domestic drone manufacturers in FY21.
This is a great initiative by the government and a very great move. In fact, just a couple of days ago, I had posted regarding this on my LinkedIn feed on how the entire country is flooded with these Chinese drones. So our ability to even make certain components or just the airframe has been taken away by these kind of imported systems, let it be completely built up or completely knocked down. So this is the first right step towards making Atmanirbhar in drones. So what I really feel is it's good that as of now that they're allowing certain components to be imported because the ecosystem is still growing. So while helping establish the ecosystem and other startups who are making these components, the smaller MSMEs who are doing some motors, propellers, speed controllers, parallelly banning this completely built up and knocked down units is a very good move. One of the major things we faced as a manufacturer is having to produce large volumes to make the product really cheap. So this was kind of a problem because the market is already flooded with cheap Chinese drones. And even though you could produce superior quality, nobody was ready to pay for the price of such an expensive system. So now with drone as a service concept, people like us, we have a fully integrated solution to capture accurate and reliable aerial data in very efficient and effective way. So this kind of turnkey solution, when bundled with the very good aerial data and per hour flight pricing kind of models, it's going to be very cheap on the customer and the client side. So our adopters, whoever needs the data, can focus on the client and accelerate all the internal decision making, while we use in-house developed and manufactured systems to give them a hassle-free experience and reduce their operational risks.
What if critical drone components continue to be imported?
While drones have become or seem to have become very common, right from drones that are used for video shoots in weddings and so on, okay, and also almost as a hobby, okay. I think when you look seriously at the kind of applications where drones can be used, be it agriculture, medical response, security, surveying, and so on, okay, it's not possible to. I mean, it's rather it is necessary to build special purpose drones which are really optimized and can perform that particular task efficiently. Okay. And therefore, I think there is still a lot to be done when we import components to actually design drones for specific application.
Sectors where drones can be employed are endless. These include photography, agriculture, mining, telecom, insurance, oil and gas, construction, transport, disaster management, geospatial mapping, forest and wildlife, and law enforcement, to name a few. The relaxed drone rules, released last August, abolished several permissions and approvals. The number of forms that need to be filled was reduced from 25 to 5, and the types of fee brought down from 72 to 4. No permission is required for operating drones in green zones, and no remote pilot license is necessary for non-commercial use of micro and nano drones. Payloads up to 500 kilograms have been allowed, so the drones can be used as unmanned flying taxis. Further, foreign ownership of companies operating drones has also been permitted. In September 2021, the DGCA launched an interactive airspace map to help drone operators check for no-fly zones or where they need to undergo certain formalities before flying a drone. The government expects the drone manufacturing industry to invest over 5,000 crore rupees over the next 3 years and generate 10,000 direct jobs. By FY24, it estimates the turnover of the drone manufacturing industry to grow to Rs 900 crore from just Rs 60 crore now. In the Union Budget, Finance Minister Nirmala Sitharaman said the government will encourage startups to facilitate drone as a service. Drone as a service allows enterprises to avail various services from drone companies, removing the need for them to invest in drone hardware or software, pilots, and training programs. The drone services industry is expected to grow to over Rs 30,000 crore in the next 3 years and generate over 5 lakh jobs, according to the government. Drone-related courses for skilling will be started at select industrial training institutes in all states. The center will also promote the use of Kisan drones for crop assessment, digitization of land records, and spraying of insecticides. Civil Aviation Minister Jyotiraditya Scindia had said in September last year that the Indian drone industry will have a total turnover of up to Rs 15,000 crore by 2026. At that time, Indian drone manufacturing companies had a turnover of approximately Rs 80 crore. With a series of these measures, the government hopes to build not just drone manufacturing, but has also placed an emphasis on the nascent drone services sector.
After the drones, let us see how stock markets reacted after the RBI's review meeting. The domestic equity market soared yesterday after the RBI's bi-monthly monetary policy struck a dovish tone. The bullish sentiment lifted the Nifty 50 a tad above 17,600 and the Sensex near 58,950. While the policy is set to comfort equities and bonds in the near term, analysts say investors should remain cautious due to huge borrowing starting April 2022, rising global yields and elevated commodity prices.
The Reserve Bank of India sprung a surprise yesterday when it struck an unexpected dovish tone and refrained from tinkering with key policy rates. With this, the repo rate was left unchanged at 4% and the reverse repo rate at 3.35% for a 10th straight policy. The Monetary Policy Committee also decided to continue with the accommodative stance as worry over growth continues to weigh. The RBI projected 7.8% GDP growth for FY23, which is slightly lower than the 8% to 8.5% GDP forecast made by the Economic Survey 2021-22. Governor Shaktikanta Das said concerns are arising from the uncertainties related to Omicron and global spillovers. Nonetheless, no immediate threat to liquidity availability and hardening of interest rates resulted in bond and stock prices surging. The S&P BSE Sensex printed 460 points while the NSE Nifty surged 142 points to end at 58,926 and 17,606 levels respectively. In the money market, 10-year government bond yields cooled off over 1% to quote at 6.7%. But analysts fear it may be too early to cheer. According to Aurodeep Nandi, India economist and Vice President at Nomura, RBI expressed a very dovish outlook for inflation for FY23, forecasting it at 4.5%. This comes despite higher oil and commodity prices, growth supporting fiscal policy, continued economic normalization, and a distinctly hawkish Federal Reserve. This suggests that RBI is likely to remain behind the curve until macro circumstances warrant a shift of gears. Deepak Jasani, who is head of retail research at HDFC Securities, too believes the RBI's latest monetary policy may raise concerns that it is behind the inflation curve.
Reading the fine print of minutes of this MPC's meeting would provide more insights into MPC's mind for not narrowing the policy corridor between the repo rate and the reverse repo rate. Though the intent of the RBI to support the recovery in the economy in the face of disruption due to Omicron variant is commendable, the fear now will be whether the RBI will fall behind the curve, having maintained the easy monetary stance longer than most other central banks have.
Assuming a normal monsoon, the RBI projected retail inflation for fiscal year 2022-23 at 4.5%, with Q1 FY23 forecast at 4.9%, Q2 at 5.0%, Q3 at 4.0% and Q4 at 4.2%. But analysts worry that inflation risks, especially from fuel prices, remain a concern. If inflation rises more than expected, markets will have to realign quickly, they say. As regards money market, movement in yields will have to be tracked going forward.
The market was expecting some announcement or action to tackle the huge borrowing program. Given the sovereign bond inclusion in the global index is uncertain in terms of timing. Perhaps the announcement on this front would be expected in April meeting at a time when H1 FY23 borrowing calendar is released.
Aditi Nair, chief economist at ICRA, continues to expect the 10-year yield to cross 7% in April 2022, once the FY 2023 borrowing program kicks off. The RBI also enhanced the debt VRR limit from 1.5 trillion rupees to 2.5 trillion rupees yesterday, expecting higher FPI inflows into India's debt market. While this could be an interesting support to the bond market, analysts say the inflows will have to be tracked as the existing limits haven't been breached. Overall, the RBI's dovish policy will provide near-term support to both equities and bond yields, but global headwinds remain key risks. On Friday, reaction to the fine print of the policy, Q3 results, and global markets' reaction to US inflation data will be the key triggers.
Uninterrupted internet connectivity is key to trading. Just like our homes and offices, every device hooked to the internet has its address. And similar to the postal department and courier agencies in the real world, the virtual world has internet protocol, which is responsible for addressing, routing, and delivering the online packets of information. But with the huge rise in the number of devices using the internet, the current version of IP, which is IP version 4, is busting at the seams. And the world is now switching to IP version 6 to accommodate billions of addresses and more. Let us know more about IP version 6 in our next report.
About 3 decades ago, computers were limited to government institutions and universities. They were bulky and expensive. Over the years, the advancement in technology has made them small, affordable, and obviously ubiquitous, and their numbers are swelling as we talk. Internet Protocol, or IP in short, manages the huge traffic of information between these billions of devices. It attaches an electronic return address to all online requests and activities. This is called the IP address of your connection. Even the website, such as www.business-standard.com, is an IP address masked behind Domain Name Service (DNS), which translates numbers into the name for Internet users to navigate the web conveniently. In technical terms, Internet Protocol is the network layer communications protocol for relaying datagrams across network boundaries. Currently, we are using the fourth version of Internet Protocol, which is known as IPv4. Launched more than 3 decades ago, it has several limitations, including its capacity to cater to billions of addresses. IPv4 is a 32-bit numeric address written as 4 numbers separated by periods. Each group of numbers is called octet. It has a limit to accommodate 4.3 billion addresses. This number might look huge, but it is not. The internet is quickly running out of addresses. So the world is now adopting the 6th version of Internet Protocol. The main difference between IP version 4 and version 6 is the length of the address. The IP version 4 address is a 32-bit numeric address, while IPv6 is a 128-bit hexadecimal address. Hexadecimal uses both numbers and the alphabet in the address.
IPv6 can produce 340 undecillion, which is 340 trillion addresses. So you might have guessed it is enough for the foreseeable future. The IPv6 also addresses security shortcomings of the IPv4 by enabling end-to-end encryption.
Other benefits of the new Internet Protocol include connecting with different networks simultaneously with a unique address on each network and the ability to combine multiple enterprise networks without readdressing. India is also upgrading to Internet Protocol version 6 in November 2021. In November 2021, the Department of Telecom released a circular revising the transition timeline, setting December 2022 as the deadline for Internet service providers to make changes to their network as required by the latest Internet Protocol. The circular has set 30th June 2022 as the last date for government organizations to complete the transition to IPv6. The IPv6 clearly has many advantages over the IPv4, but upgrading to the new Internet Protocol cannot be done in a hurry simply because replacing old IPv4 equipment would be expensive and disruptive. And so, IPv4 is being slowly phased out, giving way to gradual adoption of IPv6.
On September 24, 2019, a disruption in internet services resulted in trade outage at the NSE, impacting several participants with open positions. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.